Hi, I'm Lin-Hui from National Taiwan University. It's a great pleasure to discuss our research with you. The paper is co-authored with Chunlai from Texas A&M University, Corpus Christi. The paper is titled as the effect of the fair value reporting model on analyst forecast properties, evidence from real estate firms. In this paper, we examine how the two reporting models, the fair value model and the historical cost model, affect analyst behavior. We study various analyst forecast properties with a focus on forecast dispersion. Our research is able to answer two questions. First, do analysts have more or less differential opinions for firms reporting under the fair value versus the historical cost models? Second, does the transition from a partial fair value model under UK domestic standards to a full fair value model under IFRS lead to any difference in forecast dispersion among UK firms? In this study, we used real estate firms. We examined the real estate companies across the US and UK from 2002 to 2014 because of three important advantages identified by Liang and Riedel 2014. First, the difference between the two countries in accounting standards for investment properties allows for a comparison of the fair value and historical cost models. UK firms report investment properties at fair value under both UK domestic standards and IFRS. US firms report investment properties at historical cost under US GAAP. Second, you may ask, why do we use financial institutions in our sample? Because it is easier in the real estate industry to disentangle confounding effects than it bias the effect of fair value accounting. Financial institutions are subject to lots of regulations and they have more varied operating assets. Third, the US and UK real estate industries are similar and well developed, increasing the comparability of the fair value and historical cost models. Let's discuss the background. In our sample period, US firms report properties, plant, and equipment at historical cost subject to impairment. In our sample period, UK firms report real estate at fair value. UK firms were subject to a shift in standards in 2005 from the partial fair value model to full fair value model. Let's discuss the UK reporting regime in detail. Prior to 2005, UK investment property firms followed domestic standards, SSAP number 19, for valuing properties. SSAP number 19 requires firms to report real estate at open market value on the balance sheet and to report unrealized fair value gains or losses in a revaluation reserve account without them passing through net income. However, the UK adopted IFRS, mandating the firms follow International Accounting Standard 40 for investment properties beginning on January 1, 2005. IAS 14 permits companies to choose between a fair value model and cost model. However, all UK investment property firms reported their assets on balance sheet at fair value. IAS 40 requires unrealized fair value gains or losses to be reported in net income. In a nutshell, UK firms have reported investment properties at fair value on the balance sheet throughout the pre- and post-IFRS periods. The key difference between the two periods lies in accounting treatment of unrealized fair value gains or losses. That is whether they pass through an income statement. In other words, while the fair value reporting model applies only to the balance sheet under the pre-IFRS UK domestic standards, it applies to both the balance sheet and the net income or the income statement under IAS 40 in the post-IFRS period. To be brief and consistent with Liang and Riedel 2014, we refer to the pre-2005 accounting regime as partial fair value reporting model and the post-2005 accounting regime as the full fair value reporting model. We predict the effects of the full fair value model and the partial fair value model on forecast dispersion. On one hand, it is possible that the task of prediction is more complex and difficult for analysts in the post-adoption period, as earnings reported under the full fair value model are exposed to the temporal market changes and feature a higher number of less correlated items to the extent that not all analysts fully adjust to the new accounting standards. Analysts' opinions regarding future prospects are likely to be more divergent following IFRS adoption. On the other hand, it is possible that forecast dispersion may not change among UK firms across these two reporting regimes, as the changes in fair value estimates has been disclosed in the financial statements prior to IFRS adoption. If all analysts have fully used the disclosed information to predict earnings under the UK domestic standards and immediately adjust to the new reporting regime, IFRS will not provide them with new information or in turn lead to changes in forecast dispersion. This is our main regression model. The dependent variable is forecast dispersion, and we have UK post and interaction term, UK times post. The coefficient of UK captures the effect of the partial fair value model on the properties of analyst earnings forecast relative to that of the historical cost model under US GAAP. And we have post. It captures concurrent temporal effects on US firms that coincides with the UK IFRS adoption. The coefficient of the interaction term, UK times post, captures the incremental effect of the full fair value model under IFRS relative to that of the historical cost model under US GAAP. We are also interested in the time frame effect of IFRS adoption. So we replace post with a vector of time period indicators. For example, we have year 0502 that equals 1 for the period 2005 and 2006, and all the other time period indicators are defined accordingly. We report the main results in Table 3. In column 1, we will focus on the interaction term UK times post, which captures the shift in forecast dispersion from the partial fair value model to the full fair value model among UK firms. The coefficient of interaction term is positive but insignificant, meaning that the evidence does not point to a difference in dispersion between the pre-IFRS and post-IFRS periods. In column 2, we find that UK times year 05 and 02 is significant and positive, but we do not find any other interaction terms to be significant. We also observe that the increase in forecast dispersion exhibits a downward trend, peaking in the first 2 years of the post-adoption period and becoming negative or close to zero in the final 4 years of our similar period. The results suggest that the adoption of IFRS leads to an immediate increase in the degree of diversified opinions among analysts with UK firms. However, this effect is not permanent. It only lasts for 2 years. This aligns with the notion that it takes time for analysts to adjust to the new accounting standards. Finally, we examine the differential effects of the fair value model and the historical cost model on forecast dispersion by checking the significance of the sum of UK and the interaction term. For example, the test of UK plus UK times year 05 and 02 compares forecast dispersion under the full fair value model in the UK in 2005 and 2006 with forecast dispersion under the cost model in the US. And in panel B reports results, we find that only the last two are significant and others are insignificant, suggesting that UK firms reporting under the full fair value model have lower levels of forecast dispersion than UK firms reporting under the historical cost model after 2011 and 2012. Because of time limit, I'm not going to discuss all tests in detail. Repeat a similar analysis for forecast response time reported in this table and forecast error in the next table, Table 5. We find time frame effects of IFRS adoption for these two forecast properties. The conclusions. First, we find that after IFRS adoption, UK firms exhibit an immediate increase in forecast dispersion. However, this increase is temporary. The effect declines over time. Beginning in 2009 and 2010, we do not find the forecast dispersion to be different from that under UK domestic standards. The results are consistent with the notion that the effect of the change in accounting standards is not permanent and the analysts improve through experiences in later years. Second, we find that full fair value model improves consistency between the two financial statements, and analysts spend less time preparing their forecast. As with the time frame effect on forecast dispersion, we find that the change in forecast duration is not static throughout the post-IFRS period. Finally, we visit Lin-Hui 2014. We find that forecast error on average exhibits an increase following IFRS adoption. However, the increase is driven by earlier post-adoption years. It also exhibits a declining trend over time. This new evidence is consistent with the time frame effect on forecast dispersion and forecast revision response time. That's the end of our presentation. For more details, please check out our paper. Thank you.